Welcome to the Rose Show podcast.
Welcome to Macro Markets, Trading and More with Ryan Rozbiani. Thank you for joining us this evening. We hope to make this space educational and lots of fun. Quick disclaimer, please do not construe this as investment or financial advice. I'm Rosanna, your host, and I'm here with Ryan of Trading Together. In this space, we will discuss our thoughts on current macroeconomic conditions, markets, trading, options, mindset, risk, and our outlook for 2023, hopefully better than 22, and more. As the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. And that is what we hope to accomplish here this evening. So let's begin. Ryan, so happy to be here with you. We've had great conversations through Twitter. You seem like such a nice person. Please tell us about yourself and your business.
Thank you so much, Rosanna, for having me, first of all. Second of all, I've just been in awe of everything you've been doing. I've been a silent fan from the sidelines for a while, and it's really cool to be on here and speaking with you. My buddy, also his name is Ryan. He's in here, Captain Mara. He's spoken so fondly about you. He introduced me to you, and I was like, oh, this content is amazing. I just want to dive deep in. So a little bit about myself. I had the pleasure/curse of getting the bug of the good old stock market when I was very, very young. I grew up with a very, very humble background, so I couldn't afford to trade from a young age. And I really caught the bug in 2013 when I heard about it in my economics class. My dad had always whispered in my ear about the good old Roth IRA, how he put $50 away every month he was so happy about it. Like, he put away $50 a month. He goes, this is for the retirement. I want one day you're going to get a job. You'll be able to do this too. So I caught the bug at a young age. I didn't respect it enough to like really give it too much mind, but I'd play with it. I'd watch it. I'd like to take a look at the closing price every day, see where it went. And then as I got a little bit older, I started studying about it more and more. And I really started like paper trading at first because I couldn't afford to trade. Full transparency, I couldn't afford to trade till I got my first internship. I couldn't go to my father and say, hey, let me borrow $10,000 and let me trade. I couldn't do that. And that's okay. I think that helped my progress a lot. So I spent a lot of time learning. And then when I got my first internship, late 2017, I was able to kind of jump in and start practicing what I was testing out. And of course, theory and practice are not always one-to-one. So there were challenges and hurdles, and I didn't have FinTwit back then. I was rummaging Reddit and YouTube to learn as best as I could. And I mean, I was just doing my best that I could, and I kind of scurried my way, did whatever I could, and learned as best as I could and tried to execute there. And then in 2020, the good old FinTwit I rummaged into FinTwit. I saw there was a lot of craziness happening, which a lot of it is unfolding now. And I thought, hey, maybe I could be a voice of positivity, a voice for education to kind of input as best as I could help. And that's kind of how I was injected myself into here. And I had the pleasure of working with the FinTwit world.
I love it. I love your humble background and your upbringing. And you're just so kind and so helpful. And that's what I really noticed about you more than anything, was that you're so helpful in helping others with trading and just your mindset overall. So I am also so grateful to be here with you this evening.
Thank you.
And you made a great point. You're welcome. Theory versus experience. Agree completely. I having been in business school many years ago, and I got my graduate degree as well. There's nothing like running multiple businesses, and that kind of experience cannot be taught. And I call it tacit knowledge and implicit knowledge that you learn that over the years through experience. Now, I'm a lot older than you, quite at least probably like 15, 20 years or something. But that comes wisdom and experience. So yes, it's that experience, and you seem to have gathered that experience rather quickly, which I find very impressive. And I see you got a degree in computer engineering. Is that correct?
Yeah. So my undergraduate degree, I went to NYU for undergrad in computer engineering, and I also got a master's in management of technology. And it's called management of technology, but the crazy thing is I took a lot of my finance and financial analysis stuff, fundamental analysis stuff I was learned there. I studied under an economist that I was in pure awe of the whole time that I was in this class, Professor Pavlos, and he opened my world up to the world of economics and how it connects to everything. I studied under fantastic professor for finance to learn fundamental analysis, which even to this day, I go back to his course materials to relearn some stuff that I've forgotten. So that's really where I was able to get a lot of my fundamental analysis side of things was in grad school. And I would stay after class and ask him questions about this company, that company. And that's where like I was able to kind of skew my college education towards that stuff. And of course, the tech stuff for my computer engineering degree has helped me build the quote unquote business side of things for trading together, which we could definitely talk about more later. But that's kind of where I've been able to get very lucky and kind of fuse everything that I've done so far into the one bubble.
Very nice. Yes, fundamental analysis. That's my foundation, and most of my investing is fundamental analysis. And so absolutely, you learn that from, it sounds like from one of the best there at NYU. And I actually studied decision and information sciences, which is computer information sciences with the fundamentals, with it's a little bit of everything. Mm-hmm. It's an interdisciplinary degree. So awesome. Very similar. Yeah. So when I saw you had that, I was like, oh, we have similar type of degrees. So very, very interesting stuff. So tell us all, Ryan, sure. What are you trading these days, if anything?
Sure. So for the past several months, I've put myself on a journey of attempting to build a bot that can help me understand and trade the S&P 500 via the SPY parallel ETF. So I've been exclusively trading SPY for the past few months. That's been my go-to every single morning, day, night, analyzing that, paralleling it to what I see in the futures markets, looking at the macro analysis of the market, seeing how SPY reacts to it. And it's kind of, there's a lot of art as to what happens to it, right? It feels like the stock market is this one massive symphony. And it's this massive symphony where every single instrument in the world plays a different part. Like last night, Japan played a little louder than everyone else and caused the futures markets to tank. So I'm trading the parallel. Long story short, SPY almost exclusively. If SPY is having one of those days where it doesn't want to let me trade, I'll look to. I make a watch list every night where essentially it's not just for the purposes of creating a watch list. It also helps me practice my technical analysis every night. So I treat it like homework and an exercise. So I run technical analysis and I earmark a few plays that I like the best, mainly max 2 to 3 at best that I would be watching parallel if SPY doesn't work. But really it's been SPY. And I personally, when I first started trading, I would overconvolute with too many indicators. Now I've kind of bubbled everything down to just using the exponential moving averages. I like to trade on the 3-minute time frame because I day trade fairly quickly in and out. These days, when we have a clean trend where it's just been unfortunately straight down, I allow myself to hold my positions a little bit longer. But I like to use the 9 EMA, the 50 EMA. I like to throw V-WAP in there. I always say, like, if you can take one technical indicator with you, it'd be the 9 EMA. If I can't take the 9 EMA, I'll take V-WAP with me. And I will have RSI there as my backup to kind of keep me on my toes of, hey, we're getting too low, or hey, we're getting too high. So that's kind of the nutshell of how I like to trade the S&P parallel SPY, and it does good for me. Sometimes it's extremely challenging on choppy days, but on days like, for example, today, where it gives me clear direction in certain trends, I can do that, and I can take those trades and execute those. And I do it via options because the commons market would require me to put in a lot more risk than I'd like to. For putting capital up. I don't like to allow my trading account to go over 25K. That's just a practice that I've had for myself because I find myself over risking and oversizing my positions. So I'll keep it to 25K, and when it grows, I will pull that money out to cover expenses and bills, and I move it to my investing because at my heart and core, as much as I love trading, I like to identify as an investor. Warren Buffett is one of my favorites, so I like to identify as an investor at heart over everything. So that was a massively long answer, and I do apologize if I rambled.
No, not at all. I love it. I think I'd like to back up a little bit and ask you some questions regarding some of those trades. But first, I agree. The day trading or the swing trading is income, and then it's always taking those profits and putting them towards building our net worth, building the long-term investing. Absolutely. That's something I've been doing for over 25 years. So agree. That's very smart. I love that strategy. And I think that's so cool that you do day trading on the 3-minute. Very interesting stuff. So please tell us, what tools, what vehicles do you use with this SPY trading?
Sure,
Do you use
sure.
options?
Yeah, I use options. So I use options. I just use your basic calls and puts. I haven't really gone too deep into using strangles and butterflies and stuff like that. I'd like to keep my trading as simple as possible, even though those are fantastic vehicles that you can use for certain strategies. I just keep it straightforward to call options and put options. Um, I try not to do zero data expiration. Usually, I find myself buying them only in the morning and trading them within the first half an hour, sometimes midday if I get wonky with that. I click it. I'm finding myself, believe it or not, accidentally buying them now because I was used to the Monday, Wednesday, Friday expirations on SPY. And what's happening now is I'm like, all right, for example, today's Tuesday. In the middle of the day, I made a stupid mistake and bought a zero data expiration contract, thinking that I was clicking on the Wednesday contracts because it's there, but now it's every single day. So I got to pay more attention. So yeah, just basic options is what I've been sticking with for now. Maybe I can revert back to commons trading one day if my budget gets big enough. I could just trade commons on the S&P 500. But right now,
Yeah.
I'm just sticking to options.
Well, I got to tell you, buying the wrong day has happened probably to all of us, and actually still happens. I've done that. I do that all the time. Different expirations and so forth. Less is more. So I think it's nice that you simplified not only your charts and indicators, but your ticker to just go with SPY. And I think SPY is an excellent trade. And it's actually, if I ever do day trading, which I don't really day trade much. Or swing. I mean, I do my swing trades quite often, but I like SPY or SPX actually for options day or even a few days. I prefer a few days trades. I don't know why. I feel better when I hold it overnight sometimes.
You got more guts
But
than I do these days.
yeah,
I can't like. I used to be able like swings were bread and butter. But this market, man, you wake up every morning, there's a new piece of
I
data.
know.
You go to sleep at night, like right before you go to sleep, like last night, Japan's like, we're doing this to the yield curve. I'm like, no, you're gonna
Hmm.
ruin tomorrow. And but yeah, no, I totally get it. Like I hope that we can go back to swing trading because swing trading was a lot more relaxing, a lot more calm. Like one thing that I'm finding that's really I don't really like is sitting in front of the screen all day. That's one thing that I've been trying to like fight with myself is like to get up, like don't sit at the screen from 9:30 to 4 open to close. Like there's no need for that. But I mean, it's also because more of the fact that I'm working with the team. So I find myself having the responsibility of being there the whole time, which I find a little bit parallel unhealthy for myself, but it's kind of a sacrifice that needs to be made at some points. But I do hope to go back to swing trading, and if I can find certain setups from time to time, I will sneak in a swing trade. But it's been honestly a long time since I've been able to get into one.
Absolutely. Less, I've been doing a lot less and it feels good actually. Just doing less, I mean, holding a little more cash than I normally do. And, reduced position sizing has been working best for me, helps reduce risk and reduces emotions tied to the trade. We each got to do what works for us. But yeah, I agree with you. Swing trading has not been as fun. And it's been a challenging few months for sure. So would you say you're mostly technical based or fundamental or both when it comes to, besides the SPY trading, with overall your stocks?
So overall, my stocks, if I'm looking in for an investment, for me, it's fundamental analysis that kicks in, looking at their books, looking at their recent earnings reports, seeing where they could be heading in terms of growth, looking at the sector's potential growth moving forward. That's what I like to kind of do in terms of fundamentals. And then if I decide to take a position, I will let the technicals guide me into finding an entry. So for example, again, none of this is financial advice, it's just for fun. It's just a personal example. Like I'm looking into investing more into TSM, Taiwan Semiconductor. I know that my biggest bear case right now in the back of my head is the international relations with China and what's going on. I also know that my one of my investing favorites, Warren Buffett, invested into it, which kind of gives me a second stamp of approval on top of what I had. I have an initial position in the company. I'm looking to buy more. He gapped it up, which I haven't actually taken a look at. I'll take a look at it now. I think the gap finally may have maybe starting to fill. But I like to use technical analysis to assist me in finding my entry for my long-term position and long-term hold. That's after I can kind of figure out my best fairish price for the stock where I like it in terms of growth. And I'm looking, when I make an investment, I'm looking for like 3 to 5 years down the road, but I do reassess my investments on every single earnings report that comes out on them. So if an earnings report comes out and I see fundamentally something's changed about the company, like I used to be an investor in Meta. And when Mark Zuckerberg started massively spending money in the metaverse, which I didn't agree with because, again, from a technological standpoint, one of the courses I took was human computer interactions. And I don't think that the metaverse is ready yet for human consumption at a mass scale. I exited my Meta position at that point and diversified that cash elsewhere. So I'll use the fundamentals to guide me, and I'll use the technicals to kind of get me in when I think the time is right.
Very nice. For your swing trades, so have you not been doing much swing trading lately?
No, I could honestly tell you, I think the last time I swing traded was probably 2 CPIs ago, was when I pulled the swing, when I posted or took a swing trade. But I just can't, like, this market, it's just too volatile. It's every single day, like every single week, you've got 2 to 3 events that could be earth shaking. Like Thursday, we have GDP. Friday, we have PCE. Any single one of those could cause us, and I'm taking options, right? So which means I can't get stopped out or sell my position until market open. So if I get caught with, like, we've seen CPIs where it knifes $10 or CPIs where it moons $10. So if I get caught in one of those, the position gets completely wiped out. So I'm not confident in the market enough to pull that, or maybe I'm just not a good enough trader to be able to execute a swing position in this market.
I think it's the market. Don't yourself. We all have it. The market has been, it's really a day trade. In my opinion, it's a day trader's market for the nimble, the ones who day trade that style. But yeah, it's been very challenging overall. Of course, we all know, looking at history, this will eventually change, and there'll be plenty of great opportunities coming our way, as we've always seen in history. I mean, even 2008, and I traded during that time. I traded in 2000 as well. And, it seemed so dark. It seemed like it was the end of the world. But then look at how far we've come since then. So, it may take time, and it will, in my opinion, take time. But this will change, and things will get better eventually. We just got to stay positive and not give up. And that's what I tell people all the time. Now, with your options trading, you said you don't do butterflies. Do you do any type of spreads, any vertical spreads, or do you use options trading for risk management?
I use it. I do use it for some points for via risk management. If you're referring to selling calls against my positions, I do that to kind of. That's one of the biggest things that I do is, like, when I see a day where it's unjustified runs up in the stock market, which we've seen a lot of bear market rallies. I'll sell covered call positions against, for example, my Apple position, my Marathon position, my smaller cap positions, which have a higher density in my portfolio in terms of shares. I'll sell covered calls against them and use that to generate cash in order to come back and reinvest into the positions, or just have cash on the sides. But really, if I'm looking to manage my risk against my portfolio, one of the biggest things that I did for several months was I would use SARK, which was the inverse ARK fund. I was fortunate enough where I interviewed their CEO on my YouTube channel back in January when they first launched, and I was able to use that vehicle to be able to kind of balance my portfolio out in the beginning of the year, and it helped me a lot. Like, I would have been in a massive red year if I didn't have SARK. And then when SARK's spreads got a little bit too ugly, I switched to ARK puts, which was the same thing. Now you might be saying, why didn't you just take SPY puts overnight? The amount of risk that I was putting in, again, I didn't have the guts to take a massive amount of risk. If my ARK position would have gone to zero, I would have been completely fine with that. Also, ARK allowed me to buy further time at a much affordable rate than SPY would have allowed me to do that. And thankfully, a lot of them went my way, and the ones that didn't, it was okay. I treated them as an insurance policy. So I always say a hedge is like an insurance policy.
Yes.
We buy insurance for our cars or houses, and we hope to never have to use it.
Yes, exactly. That's what hedges are used for. I sell cover calls as well. I also buy inverse ETF calls. So I would say my swing positions have been the inverse calls, and I usually put them in diagonals or vertical spreads, sometimes calendars as well. So that's been my swings, and I'll share with you a little bit about my swings. I haven't really been playing many stocks. I mean, I have my long-term holds, and I tweet about them all the time. SMCI, Enphase, and they've been holding up pretty well. They're fundamentals. I'm such a fundamentally based investor, and even my swings are fundamentally based. It's almost, difficult, especially in this market with compressed margins. And we're going to get into all the earnings and everything soon. But for me to take a swing trade, it has to be a fundamentally strong company, which is like SMCI, Enphase, and there's quite a few others out there. I was a Caterpillar deer trader recently. I've been taking profits, so I'm almost out of those. I'm not going to hold industrials.
Awesome.
Yeah, those were great. And I mentioned it in September because I was looking at the I'm a CEO of a manufacturing company. So I've been noticing that industrial sales have been picking up, and manufacturing as well as new orders in manufacturing tends to be a leading indicator for trends and for earnings. So I noticed the trend earlier, I'd say spring, that industrials were starting to pick up. So it proved to be pretty good by this fall. So I got a position back in September. So it's worked out well. So there's quite a few that I'm slightly bullish on. You can either say less bearish or a little more bullish, whichever perspective you want. But for me, the swing trading has definitely been on more of the short side, which is the inverse calls and some puts as well on just straightforward. But yeah, overall, it's just been challenging and you need to just be careful. And I've been enjoying holding more cash as well. And commodities have been the play recently. I don't know if you play gold and silver.
No, I don't. I haven't had the opportunity to. If I don't know like a sector well enough, like I'm not too well versed in gold or silver to be confident enough to touch it. Like the newest sectors that I've been really looking more into is energy and oil. And again, I've been looking into it, but if I'm not 100% confident enough where I can kind of, if I can't teach it, I'm not gonna I'm gonna try my best like not to touch it or trade it because I don't want to do the wrong thing or take a wrong execution on a trade where I screw myself over because I didn't have the proper education when there's an ocean of things we can trade.
I love it. Very prudent. That's a very smart mentality. That's a great way. That gives you staying power in the market, knowing what you know and trading what you know. I guess you really do follow Warren Buffett quite well because he seems to speak about that quite often, that you need to know what you trade. So, but yeah, I traded gold and silver many years ago. I think in the 2000s time, 2007, 8, 9, whatever, that whole time period. So I was familiar with it, and so it's been working out pretty well. So that's a swing trade for me as well. So when I speak of swing trades, it's these type of items that I'm focused on, and I've been trading commodities through futures. So yeah, so it definitely takes time to learn it and understand it, but another vehicle for you to explore. So, let's talk about, now we've been talking about CPI, we mentioned commodities and earnings. Let's go a little into the macroeconomic factors, which I know we both find very fascinating as we both studied economics. So, what are your thoughts on the Fed and inflation and all that's going on with CPI?
That's the $1 trillion question. I'll be honest with you. It's been the wildest cycle that I've ever seen. And again, I'm 27, so I haven't seen many cycles, but I've studied a lot of these cycles. Look, inflation is high, but the unfortunate thing here is that the Fed, I don't think, has the tools to be able to properly take down inflation. And we look at inflation with headline CPI numbers, right? Looking at the headline CPI numbers, the biggest factors that were affecting it 6, 8, 10 months ago, one of them was, for example, used car prices. The used car prices regulated themselves as rates went up and people were priced out of loans, and that dropped significantly. But then you have things like energy and natural gas that are just extremely high, that are causing inflation across the board. Everything is affected by this. And the Fed, unfortunately, doesn't have a reserve, an oil reserve, to be able to help out the federal government to be like, hey, here's oil. So they're increasing rates to initiate demand destruction within the markets. And this is it's gotten to a bit of a point where I think like the Fed has pushed to a point where I think it's like, hey, like maybe slow down before we cause some massive damage. Because one of the things that I've studied and I've been looking at more and more is with every 1% that we raise our federal funds rate, our debt repayment goes up by $300 billion. And we can end up in a debt crisis if we go too far because you're shooting you're shooting one end to save the other end, and then it just becomes like you're just bleeding out on both ends at this point. So I think, again, I'm not Jerome Powell. I'm not as smart as he is and his analysts are, but I don't like high inflation. I've never liked high inflation. No one does, because you end up paying more. But I also feel like the Fed has done. The Fed started extremely late. They should have started last November when they first started rumoring about rate hikes and slowly raised them. They whammied us with 4 consecutive historical 75 basis point rate hikes that we're going to start to feel the effects of in our economy. You're going to start seeing it in earnings reports more very soon, because there is a lag that the Fed never acknowledged until, I want to say, 6 weeks ago, 5 weeks ago, that there's a lag between their rate hikes and this. And everyone thought that, oh, we're going to raise 50 BPS today and inflation will go down tomorrow. And now they're just starting to acknowledge it. So I think that the Fed set itself up for a really bad battle in first denying inflation, calling it transitory and ignoring it and hoping it goes away. Then the Russia situation happened, which fueled the fire with inflation due to energy prices. And then they whammied it very, very fast and very hard. And now we're starting to see the effects. And I think if I was the Fed and if I was Jerome Powell, I think the decision of going past the 5% federal funds rate at the current standing of time was not correct. I think we should have stuck with the 5% federal funds rate, a terminal federal funds rate for now, reassessed, and then came back and adjusted in the future. Because what's happening right now is our markets are trying to price that in, and individual assets are being completely decimated. Because of this, you have stocks that had like 100 PE, which is extremely disgustingly overvalued, now down to like a 15 or 20 PE. And some might say that's justified, some might say it's not justified, growth or whatever. That's not the point. But I just feel like the Fed's going really hard, really fast, and hoping to catch themselves up from where they messed up. Where I think that you have to take into account the economy and the people, because that's the thing that gets lost in these discussions as human beings, right? You've got folks with retirement accounts that are getting decimated, that are going to be retiring in 4 to 5 years. They don't have another 10-year spurt to be able to do this. You're going to see people retiring later because their retirement accounts just don't have the funds anymore, because their money managers are idiots. Like when I was in the process of purchasing my apartment, I went to the bank and I spoke to someone, and she was actually one of the ones who handles these accounts. And I asked her, I was like, hey, what are your thoughts on the CPI and everything? And she goes, well, to be honest with you, I haven't really paid attention to it. And I was like, well, it's coming out tomorrow. She goes, oh, I didn't even know that. And I was like, what the hell? Do you manage all this money? I didn't say this to her because it's disrespectful. And then I talked to one of my buddies who has his money with these folks. And I was like, did they rebalance you? And he goes, no, I'm still in ARK K and ARK G and all these tech stocks. And I'm like, what the heck? So I'm like, so this parallels to me at the macro scale. Anyone who has these retirement accounts are being completely destroyed because everyone was put into tech because tech was so hot in 2020, 2021. They didn't take profits because they thought the gravy train would keep going, and now they're being destroyed. So for me, the most important thing here that I'm worried about is people, because it feels like Jerome Powell has a massive initiative to raise unemployment, to initiate further demand destruction, and retirement accounts are getting destroyed. Because I don't care about the massive funds there that've got billions of dollars. I don't care if they lose money. I'm more concerned about the average Joe who's got like $50K he saved up his whole life through the S&P 500, which is now down, like 15%, 20% on the year?
That's such a nice perspective. The people, and mentioning the people, Ryan, I value that statement a lot, because that's who's really getting hurt here. It's all these retirement accounts. And the Fed made mistakes when they went so low on their rates. That's my opinion. I think they went too low, and I think they should have started raising rates much earlier than they did. So they're trying to catch up quickly. And by the time the rates work their way through the system, we don't know the total effects, because there's data lags. And the housing market, which we're going to get to, has a very slow it's a slow process with a lot of data lags. The labor market as well. There are a lot, and I want to get into the labor market. That is one of my areas of study. And there is a lot of inconsistent data that is involved with the labor market. And I'll start with the CPI. We've seen a deceleration in the CPI. The past 2-3 months now, we're starting to see this month was mostly due to the medical, transportation, and energy services. I mean, they've been signs of the actual service pressures building up in the CPI. The services are very sticky. See, service spending is mostly a function of employment and wages.
Right.
So they usually run together. And so if it weren't for this low month of medical services, October was negative 0.6, November was negative 0.9. It was rising before then. If it weren't for this, we probably wouldn't have seen as much of a drop. And that's what's concerning to me. Will this drop, will it keep decelerating? We don't know. I mean, this is uncertainty because, there's a lot of uncertainty. So for me, I won't get too excited to say it's all coming down just yet until we see the next few CPIs, which are very important, very critical. Like you said, remember during COVID, not only the growth stocks, the tech, all these things were inflated. Everything was running up. People were buying goods like crazy. So goods were inflated. And then we had major supply chain issues. And so the prices went up high. So we had like a supply side inflation, cost push inflation, excess money was printed, monetary inflation. We have a lot of different issues going on. So now those goods, like the used cars that you mentioned, are deflating. So it comes down to wages and services. And the wage inflation, and I've spoken about this before, how it actually fuels the nominal demand and the nominal spending. And it's like they work together in a loop. But at some point, that has to end. So, employment is pretty stretched. So services spending is compensating for this contraction in goods and real estate spending. So as the Fed tightens its monetary policy with the goal of higher unemployment, because the labor market's very tight. So they want to increase that unemployment. Services should weaken, but that's also going to likely weaken GDP. So we have a lot of moving parts and a lot of issues. And of course, and I've said this before, the only certainty is uncertainty. So eventually in time, this should retract. The inflation should come down. It should, eventually. But then my question is, could we possibly be at a new elevated level of inflation, higher than 2%? I know Powell keeps speaking about going back to 2%. But maybe we'd be at maybe a 3%. I don't know. I'm not an economist, but it's just there's so many new different issues that are very interesting with all that. I'm wondering, entrenchment. Okay, so entrenchment is a real issue. And I know Powell talks about it quite often, but entrenchment affecting all of us nowadays. It's affecting our price and wage settings, which in turn affect the household and financial decisions for people and for businesses. And it's facilitating a continuation of inflation. So like, for example, our business, I still, until a few weeks ago, receive a letter from one of our vendors that says one of my parts and supply, a component, is going up in price, another 5 to 10%. So to me, I'm wondering, are these parts really going up? Is it part of the ebb and flow? Is it just going through the system? Or is this entrenchment? Are they capitalizing on this new norm of higher prices and raising prices? So is it entrenchment at work, or prices still going up? So as I said before, the nominal spending continues to fuel the nominal demand in a loop, but it can't sustain itself. So it either needs more output or more money. So at some point, that cycle is going to end. So, and the slow growth is another big concern. Between rising rates, lower productivity, we're getting less output per dollar. So that's a concern, and it's declining. And compressed margins as well. We have a rise in the cost of goods sold. And we also have a rise in operating expenses, but it's not just the operating expenses. We have new expenses. As I'm fortunate to be CEO of the business, and I see these. Maybe it's not good. Maybe it's not good that I'm seeing all this, because it's very stressful when you see all these new charges. There's like an IAS surcharge for the employment. Now, when you talk about wage inflation, it's not just the wages for the workers, but it's also all these new fees that are being added on. And New York, part of the enhanced benefits during COVID, they ran out. So they had to borrow money from the federal government. And so now we're paying this new fee, the IAS surcharge, to cover for that New York State borrowing. So it's like all these new fees. I'm sure hopefully eventually these fees will be gone, but it's going to last for some time. So, and then further earnings pressures as well. So as the rates work through the system, there's diminished future valuations and there's slowed growth. And, we have this compressed margins and there's just a dilution of value. And that's what I tend to call it. We're just getting less output for every input. Now, I don't want to go on and on and on, but I do want to touch upon the labor issues because I think it's important that everyone here knows about a little bit more about labor. I've researched this and I study the labor market and I'm being involved in the business world. I see it and I experience it every day. So New York was a little different. You're here in the New York metro area as well. So, during COVID, how challenging it was here. Being an essential business was very difficult to remain an essential business. And, so it was very difficult for us to stay open. What we actually ended up doing was we repurposed some of our equipment and we turned some of the equipment into hand sanitizing making equipment. And we ended up making hand sanitizer for free. And
awesome.
We did that. Yeah. So it's just like you said about being a good humanitarian and it's about the people. Right. And we felt being in manufacturing, we're the backbone of production and our business was located in the epicenter of COVID. And it was really really disheartening to see all the people in our area, having to be closed down, businesses going under. And so we were able to make some hand sanitizer because it was a shortage. There was price, remember there was price gouging.
Massive gouging.
Yeah, and massive. And so we used our equipment and we had a lot of workers that stayed home that couldn't work because they had relatives or they had close family members, elderly family members that, couldn't be exposed to COVID. So they stayed home. And being in manufacturing, having workers stay home was not good, because how are they going to build anything, right? So our business was really, it was really difficult time. And so we gave away hand sanitizer to our fellow business people in our area so they were able to maintain the strict standards because New York was very strict with, having to keep your facility very clean, social distancing, and so forth. So that was just another aside, sorry, but I just want to get into that. But, labor is key. The labor is key to inflation. So when the Fed says we need a softening of the labor market, we have to wonder how much to soften. And so it's not only unemployment, but we look at many more data points, such as claims, NFP, JOLTS. And then there's two ratios I like to look at, the Beveridge curve, which is job openings to unemployment, and the fill rate, which is job openings to hire. And when you look at all those, you say the fill rate shows us that there may actually be less softening needed. So it's really concerning that if they, as you said, if they tighten too much, and this unemployment number starts rising rather quickly, what's going to happen? Can something break? And can we have much bigger issues than what we anticipate right now? So there's a lot of issues. What are your thoughts on the labor market? Are you concerned with what you're hearing and seeing as well?
Yeah, the big concern I had during COVID was labor market participation. That's what the Fed was really talking about. And the thing that really, this is a weird conversation I've been having with myself in my head for the past few days is his gung-ho-ness to soften the labor market after fighting so hard. Every single cycle he'd come out and talk about how enough people aren't working. There's 2 job openings for every 1 person who needs a job. People aren't working. And now he's like, all right, you know what? I'm going to punish you. You don't want to go back to work. I'm going to tighten this so that you guys don't have these jobs to go back to. Or the people who have jobs we're seeing the layoffs in massive tech, right? In January, it was hilarious. There'd be
Yeah.
articles out of Amazon and Google. Hey, we want to hire engineers for an extra $50,000 a year because we're looking for talent to get the best of the best, and we'll give you everything you need. And now they're laying those same engineers off because of the tightening that's being occurred, and it's affecting the labor markets. I mean, the labor markets, like you mentioned earlier, affect a lot of the most important things, such as our GDP, right? You want market participants to be able to participate in the market. If you have money, you can contribute to the economy by buying things and cycling. Whether it's going to your local coffee shop on your way to the office, or buying lunch out, or going out with your family to the movies. So for me, it's it's very hard for me to wrap my head around the current labor market, what's going on, because it feels like Jerome Powell was starting one thing, one narrative, and he flipped 360 overnight to, hey, I'm going to punish you guys now and no jobs for you.
Yeah, good perspective. You know, it's another thing about being in the New York metro area. We had a different phenomenon that occurred here than the rest of the country. And I was talking about this a little earlier in the summertime. We had an influx of so many workers applied to our place of business. Mm-hmm. And it was because of the post-COVID backlash. A lot of businesses, even though they had some, PPP loan, I have to say it gets a bad rep, but it helped a lot of people, especially in the New York metro area. People just don't understand. If you're in the middle, in the middle of nowhere, let's say, I don't want to name any place, but, remote area from New York, you just don't understand how it was here. And you're here, you remember how difficult it was. So many businesses that were just forced to close down, and they could not reopen for a very long time. And then, even though they had some PPP money or other kind of assistance, they were able to reopen, but now they still couldn't recover all those months' losses. So they're forced to close down. A lot of small businesses in our area have closed. So we had a huge influx of applicants. I mean, more than I think we've ever had just during the summer, the spring to summer. And while other places were having a shortage of labor workers, we were actually having all these people applying. So it was like a different effect here in this little area here, because we were the COVID epicenter. So there were a lot of other issues going on. But I agree with you regarding Mr. Powell. He doesn't want to repeat history in the 70s and 80s, and he references that period, that he will maintain a restrictive policy until the job is done. Right. So, how strict are we going to go? And that's the question. Now, looking at FedWatch tool, which I like to look at, I think it's pretty right on with probability of what kind of rate hikes we're getting. Mm-hmm. It seems to say we're going to get another 25 in February, and then high probability of another 25 in March. Right. So that'll bring us almost close to that 500 basis points, the 5% Fed fund rate that we appear to be at before mid next year. Now, of course, things move so fast in this economy, in this market. So I only plan like 3 to 6 months ahead. So who knows what can happen by next May, but it seems to say that rate hikes may be pausing, according to Fed Watch tool, by that time period. But we do know historically that the Fed funds rate should be higher than the CPI to help bring down inflation. So we'll have to stay tuned and see. Most critically are the next few CPI reports, and watching the labor market as well. And I want to mention something very interesting. I tweeted about this back in August. If you look at the NFP, they use two different surveys. They use a household survey and an establishment survey. And to calculate the NFP numbers, they use the establishment survey. And what that survey does is that if employees are working at more than one job and they appear on more than one payroll, they're counted separately for each appearance. So the numbers sound like they could easily be skewed. So that's a real disparity that goes on with the way the data is collected. And we know that the number of multiple job holders has increased significantly since early 21. So, there are a lot of factors going on. So hopefully things, turn for the better. But it does seem that stagflation is a very possible outcome, or a recession. What are your thoughts on that? Recession, do you think with the yield curves as inverted as they are, and stagflation, what do you think of that in the near future next year?
So I still respect the original definition of inflation, which was two negative GDP prints in a row. This third
Yes.
this third GDP print that came in positive was, I don't like to, it was a little bit odd.
Yes, I agree with you.
But we'll respect it for the terms of this conversation. But the other biggest thing that I'm seeing is I'm seeing people's spending drop significantly. I'm seeing data coming out about savings accounts being drenched, not drenched, being kind of sucked out. Right? I just blanked on the word for is strained. They're being strained, and I kind of feel like we're in a mild recession right now, and I don't see that slowing down for a while. And I think that we're going to have a recession until the Fed realizes, and I think the Fed's probably gone a little too far. If they definitely go over 5%, I think they've definitely gone too far because, and I'm not going based off of what I think, right? Because I'm just some guy, right? I spend a lot of time reading a lot of this stuff, and a lot of people parallel this sentiment. I think that I agree with the Fed funds tool where we need to pause between March and May. We need to hold a pause there where there's no rate hike in May, where he just pauses for a month, takes a breather, to see how the world plays out and sees how things goes. And I think the Fed needs to take into account. Yes, they claim not to look at CPI, but every time he talks about inflation, he mentions CPI. So I'm going to mention CPI, and by him I mean Jerome Powell. He needs to take into account that the factors of the cost of energy, the supply chain issues, which raising rate hikes isn't going to help. It's going to help destroy demand, but you don't want to destroy demand to the point where that demand is unrecoverable, right? Because you can get to a certain point where you've destroyed such demand where people are just I'm sorry, but this is the scariest thing. They end up homeless, right? They end up without a job, and recovering that demand is almost impossible because, like, look around in New York City, for example, the homeless population has significantly gone up, and it's a significant issue.
Yes.
And there's no plan for reintegration or reversion. Now we're talking at the most extreme side of things. Let's look at another side of extreme things, right? People end up with massive credit card debt that they can never pay back. Even if they go back and get the same exact job, they're now in this well of debt that they can't get out because of this massive demand destruction that happened, and things have gone up, right? One other thing that we're dealing with is a wage price spiral that's looming, right? Wages keep going up. So, and because people want to retain their talent, and they can't hire because budgets get cut. So, okay, we can't hire someone out new, but this one position, if we close it, we can spread the funds across 7 people. We can keep them around, keep them from going from Goldman Sachs to JP Morgan or whatever the story is there. So I think we're in somewhat of a recession right now. We're going to see the numbers come out after the holiday season, especially I think Q4's numbers for companies like Amazon and Macy's, Aeropostale, all these different publicly traded companies that are in the retail space that sell directly to people. I think they could be negatively affected. I hope they're not. But based off of stuff that we saw from like Black Friday data, Cyber Monday data, you're going to see people kind of slow down their spending. And we're seeing that already in the spending data, right? So I think it's going to be affected, and you're going to see this compression in earnings moving forward too. I think we're not going to admit it, right? The same way that Jerome Powell didn't admit that inflation, he kept saying inflation is transitory. They're not going to admit we're in a recession until they get to the point where it's too far out, and then he has to start cutting rates. That's why, like, a lot of people like to parallel 2008 to now. From the beginning of this situation, back in February, I put out a thesis that we're very parallel to 2018. We're going to tighten, and I think we might even end up over-tightening. In that case, it was more quantitative tightening in terms of balance sheet runoff that caused us to revert back, not the rate hikes. The rate hikes were mild, 25 basis points, everything. And the markets really didn't shake too much at that until they realized, oh, we might have gone too far. And then they started to shake, and then they reverted, and we V'd back. We had a V-shaped recovery back up all the way up until COVID, and then COVID gave us another V, and then the Fed did the same thing. They cut rates, and then we V-shaped back up, and it feels like we're in this perpetual cycle of oh, we've gone too far, or oh, a disaster's happened. We're going to do this to save the markets, and it's just at the end of the day, it goes back to me. It's all about the people, right? I'm 27. I can afford to have my retirement account go to pennies on the dollar of where I invested onto it and allow it to revert back because I've invested in companies that I believe in, the Apples of the world, right? Apple's not going anywhere. We're all going to buy the next iPhone, pending demand destruction, and I think that it's just really, really. I think the Fed needs to take into account things beyond just things like CPI and unemployment, and go into the nitty gritty and realize that, hey, these are things we can't solve. We need to reach out to the White House about energy issues. The Fed needs to work with the White House, even though the Fed's not a federal entity. It needs to work with the White House and kind of. I know I hope they're aware of it, to make them further aware of that this is a magnitude issue that's going to be affecting this. And we have an election coming up in 2 years, right? I don't like politics. I don't get involved. But people vote with their wallets more than anything, right? And if things are too expensive, things are too wild, and if you're running for re-election, you're going to want to be reelected. People are going to have to be happy. So I think that's what we're going to start to see massive changes happen in late 2023, early 2024. That's why my original thesis was a parallel to 2018. It was 1 to 3 Vs, which we got, which were these mini bear market rallies. I extended that thesis when I saw the Fed was going further, and I made it to V6, which we're in right now is V6 of my thesis. We might get 2 smaller Vs for February and March. I haven't looked deep enough into that to be able to comment on that, but I think eventually they're going to pause rates because everyone thinks pivot is a rate cut. Excuse me, it's not.
It's
a
not.
Pivot is a pause for an extended amount of time, holding rates consistent, which the markets might like that for a bit. And then when the Fed sees things have either gone too far or something bad happens, then they start to slash those rates, and markets love that because it's more cheap money, and then you see markets rally more there. So it's like the 2020, 2021 market, which a lot of the folks entered into, is not the usual stock market. You have a boring S&P 500 the years before that. You had movements here and there, but it wasn't these massive swings of $10 up, $10 down, or unless something wild was happening.
Agree. Absolutely. It puts things in perspective. That was an anomaly of a market. And I can tell you, I've been trading since 2000, not full time. I'm an entrepreneur, so I've run multiple businesses, but I've always been an investor. So I've experienced a lot of the bear markets in 2000 when we thought it was just all over. And then Amazon emerges as a leader. And then 2008, difficult, the financial crisis, that was bad, So these are some difficult times, and we always come back from it. But I have to say that, the rise in debt and, savings went up significantly. I think I saw earlier in the year, and then now we're seeing the reverse effect. Savings are being squeezed or drained, as you want to say, and debt is going up. And now what else is going up? The rise in the cost of debt and capital. So you have rising debt levels with rises in costs of those rising levels. That's a recipe for a disaster. So those are very concerning. Margins are compressed. I've been saying this, I think, since last year. I'm just seeing that earnings slowly are getting compressed. Earnings per share are coming down. And I always look at the margins. Having done this for a long time and seeing how you're in financial analysis as well, it's about the earnings per share. We are shareholders here. So we want to know how much we receive per our share. And margins are key. And it's not just about revenues. And a lot of people look at revenues, and it's about the margins. And I look at the 10Ks and 10Qs and 8Ks. I like to read those for brevity. And I'm always looking at the top companies, the big caps. And I always watch, Amazon, all those companies like you mentioned, and my companies. I have my long-term holdings as well, my Enphase, SMCI, and I have some cybersecurities, but I really have minimized tech holdings overall. And so, but I'm always listening to the earnings reports, and I've been seeing a consistent pattern of margins getting compressed. And I'm holding like SMCI, their margins are increasing. Enphase, margins are increasing. Fine, the PE is high on Enphase, that's fine. I don't focus on PE with a growth stock. That with a growth stock, it's not about the PE, but it's about, they have, exactly, and they have increasing margins. their free cash flow, which is number one. Free
Exactly.
cash flow yield is what I gauge all of my fundamental companies is free cash flow yield, free cash flow margins, and I'm always watching that. Let me tell you, Enphase is like 28% free cash flow yield, something like that. I think their margin, this is off the top of my head, I'm not looking at it, but very high. They're like a cash cow. And which is why everyone always asks, why are you in that company? When the growth changes, I'll leave. And I do that all the time. If the fundamentals change, I'm out of there. But so far, the growth story is intact, and the price isn't too bad. I mean, I got in July 2020, so
now I know why you're saying the price isn't too bad.
I got in. My first buy-in. I actually tweeted it like over the summer because I was so proud of it. I was like just looking at it. I think 58 or 57. I went in pretty heavy then, but then I also added a little higher, so my cost base is higher than that. But still, it's very low, and I use it to sell covered calls, and that's what I do with my long-term holdings. Is I have my long-term, and I sell covered calls. I sold covered calls on SMCI recently as well, as it popped over 90s. So hopefully those expire worthless. But I only sell covered calls on a portion of my shares. I don't sell on all of them, and then I do roll them out. I do all kinds of movement back and forth, but and overall though, this market, I have to say, for selling covered calls, it has been more forgiving than in a bull market, obviously. So, because it does swing back and forth and it does pull back. So if you sell on green, and I have my rules that when it's green, I sell my covered calls and so forth. But yeah, so basically the earnings issue, like you discussed, I agree. I think earnings are going to be further compressed into next year. So, and earnings have a lag as well. So you're going to see, even when we start seeing some improvement, you may not see it right away. So there are a lot of people talking about double bear markets. Mid next year, we're going to see labor market unemployment going up really high. And, a lot of those kind of issues. There's a lot of talk about all kinds of things. And I stay current with everything. And I keep an open mind. That's the most important thing. I'm just very flexible because anything's possible. Anything can happen. And if things really go really south, I would think that the Fed would make a change. But in my opinion, and I spoke about this on a macro space a couple weeks ago, my opinion is that we're most likely going to get a pause, I think probably by mid next year, maybe May, maybe June, around that time period. But in my opinion, I say that quite often, in my opinion, I don't foresee a pivot, meaning a rate cut next year. December is the remote possibility as of what we see right now, but that's a year away. Things can happen. Lots can happen between now and then. But if things go really bad, maybe. But the way Powell's speaking, looking at our labor market, looking at our CPI print, which is still highly elevated, 7.1 is not a nice number. It's a very high number. It seems that he's going to continue course. And I've been saying this since I think May. I mean, they're as hawkish as you want. I mean, as hawkish as you can get. And their primary goal is to reduce inflation, which is right. I mean, entrenchment is a real concern that can keep inflation embedded at all levels. So we must avoid that. You know what? Let's talk about comparisons. You brought up 2008. And I have to say, you're very smart. You keep saying you're 27. You speak like you have wisdom much older than that. So you're very smart. And I love how humble you are. It's very important to be humble with the market. It's like an ocean. And I always say that the market is like the ocean. And we are like surfers. And we are trying to catch the waves and catch those swings. But the market will eat you up. And
it'll humble you.
Absolutely. And it has humbled me many times. Back 20 years ago, it humbled me. And let me tell you, it's humbled me recently as well. Humbles all of us, I think. We all get our losses. Exactly. And, it keeps us in line. So we have to respect it, and we have to know our limitations and trade what we know. Like you said, I love that. Trade what you know and do what works for you.
Exactly.
Don't follow other people into trades. And that's a big thing with FinTwit community. It's unfortunate. A lot of the newer traders who came in on the scene in 2020, they everything worked. So now they have this pattern of following other people with their trades, and just don't do that. Just do your own strategy, your own plan, and ignore the noise. And that's what I try to tell people. Okay, so we learn. Yeah, thank you. So we learn through studying historical time periods and comparing them. You being an academic, being also like me, studying business and economics, and that theory is different than experience. However, when we utilize theory, how do we learn? Well, in business school, I studied historical periods and I studied other economic cycles and business cycles. So we've learned that no two time periods are exactly alike. Of course not. However, there are many different variables. There are many similarities along with those differences. So by studying, we can better understand that situation. So hopefully we make better informed decisions this time around. We see that with Jay Powell. He's using comparisons too. He's comparing us to the
Volcker.
70s and 80s. And Volcker, exactly. Are we like the 70s and 80s? Exactly, no. However, he uses that to learn as theory and to avoid those consequences of persistently elevated inflation. So that's why he's going to keep at it until it's done. So, and you brought up an interesting thought the other day, actually earlier in the month, and I looked at it and I think I retweeted it. So you're comparing, you're welcome. You're comparing our housing market 2022 with similarity. You said one big similarity to 2008. Could you please tell all of us that similarity that you saw?
Sure. So if I can just give a little bit of background on 2008. So I went down a rabbit hole. This was a Saturday. I was at home, and I just went down a rabbit hole and started researching more about 2008. Again, we've all heard about 2008, but we've all heard only about the stock market crash. We haven't heard about what really caused this crash. So what happened was they sold and gave out a lot of dirty loans. People sold a lot of collateral against these loans. And a lot of people were investing in these collaterals against these loans, and these instruments started to fall apart, and they caused a massive crash. The Fed had to step in. The government had to step in, bail out these banks. You probably heard the term too big to fail. Too big to fail was one of the biggest things being passed around. Then they, quote unquote, saved a lot of these companies. A lot of these companies were merged and acquired. Some fell apart completely. They passed the Dodd-Frank Act to prevent a lot of these things happening. But the biggest issue that caused a lot of these things to fall apart was essentially the home prices fell, and what you owed on the home was worth more than what the home was. So like, let's say you bought a home for $300,000, and then after your interest payments started to balloon, you owed $350,000 on the home, and the home was now worth $250,000. So now you owe an extra $100,000 that you'll never be able to grasp on, right? Because the point of real estate is you buy it, you invest in it, you pay for it over time, and then over time it gradually increases in value because they're not making any more land as far as I can see, and Elon Musk isn't too close to getting us to Mars. So that's the biggest thesis around it. And the parallel that I'm seeing here, again, not 100% parallel to 2008, because a lot of these messed up loans were capped. They were removed, they were solved. Dodd-Frank helped it. There are some instruments that were put in to kind of load balance these markets in case this happens again. They haven't been tested yet to their full extent, but they've been put in there to kind of prevent this from happening. And I don't think you'd have a massive crash to that magnitude. But the thing that's happening a lot more and more, and a quote came out of Yahoo Finance. They said, and I tweeted this out, I said the first bad omen of 2008 repeat is hit. They said about 270,000 home buyers who bought during the red hot housing market this year will owe more than their house is worth, which was one of the biggest triggers that happened. Now, I do know, I started reading up a little bit more on this matter, and I saw that there are still certain instruments being sold, some credit default swaps still being sold against these homes and against these loans and against these different instruments. And I'll find these things and I'll post them later if I haven't posted them now. and there's a lot of leverage that's been posed into it, into our markets, into the real estate markets. And that's what kind of gives me a little bit of fear into it. Now, a lot of people love to post the 2008 chart versus 2022 chart and kind of manipulate it mentally to make it look the same. Sure, they look similar. You're going straight down, right? So it's a very, very similar situation. But I think the housing market is going to be hit significantly. That's why, like, when I see that people with investing further into real estate, especially at these rates, it confuses me, because the rule of thumb that I saw, again, I'm not proficient enough in real estate to be able to fully I'm not an expert on real estate, but the rule is usually that for every 1% interest rates go up, the value of your home has to come down $10,000 to match that. Usually the home markets kind of load balance themselves until values start to accrue back up again. We haven't seen that happen yet, right? We're slowly starting to see that happen now, but early on we haven't seen that happen. We're at 4.5%. We're not seeing homes down $45,000 in price. You still have extreme demand in certain parts, and what's happening is the rates are going up. So you're seeing a bit of demand destruction in the housing market right now, but that demand is being moved to the renters market, and rents are going up significantly. So you're going to see massive rent spikes happen there. So it's a lot that's happening. Now, will it parallel 2008? I really hope not, but it's just something that I'm keeping in the back of my head for the housing market, which could, again, it's not for me to capitalize on a massive drop in the housing market in terms of taking like a big short. I'm not trying to pull a Michael Burry move. It's more of, I think it could pose an opportunity for people who are looking to purchase real estate and invest in real estate for the long term. So I think it'll create an opportunity if you can catch it at that sweet spot where a massive drop happens, and it doesn't happen overnight. This is the mistake that people make, is everyone's been waiting for a 2022 COVID crash, but the S&P 500 has gone from 780 all the way down to 350. It's a crash. It's just over a massive span of time. So people are waiting for this massive crash now in real estate, and I think you're going to see a slow bleed. And if you can catch that period of time where it's a slow bleed, and the Fed pauses rates or even maybe starts to cut rates and slows down, because in their table of economic projection materials, they're saying they're going to lower rates in 2024 and 2025 because they're expecting things to get better. If you can catch that sweet spot, it could be a great buying opportunity for real estate. It's kind of the same way where 2020 was 2021 were great opportunities for buying real estate because interest rates were low. Yes, prices were high, but interest rates are low. They kind of mellow themselves out, but I always see a lower interest rate as a phenomenon. If one of these two is down significantly more than it should, it poses a phenomenal advantage in the world of real estate. Again, I'm not a professional in real estate. I'm not an expert in real estate. I'm still learning as best as I can, but this is just kind of the points that I've been able to kind of accrue.
I love it. It's a great perspective. And that's how we learn, is through smart people like you giving us your perspective, your analysis, and what you see. And I think that's a great point we should all be aware of. I mean, let's just preface the whole discussion of real estate. I mean, my first business actually was a real estate development business. So I've been in real estate for a long time. I was actually out of college, late 90s, 2000, that time period. And so, interest rates right now aren't really that high,
Right, exactly.
Compared to last year, absolutely. However, we had an abnormally low rates. So when we want to use the proper barometer, we need to say, how far are we from the average of where rates should be? So to me, they are not that high. However, at the same time, they're quite a bit of a shock, and they've moved up so quickly, and the home prices have not really come down that quickly. So one, real estate market, extremely slow, the slowest, I would say. As I actually tweeted, it's like a snail today. I think it's very slow. There's data lags and very slow. Now, home sales are down. However, home prices are still higher year over year, but they are declining month over month. And I think the biggest drop was this past month. But still, home prices are still higher than year over year. However, mortgage rates are significantly higher than they were a year ago. So there you have that inequity right there. So there's a lot of things that need to be worked out in the housing market. Yes, it could get much worse. There are a lot of issues that point towards not just a cooling, but maybe much worse than that. Now, of course, it seems just like the people who say we're not in a recession. I like your definition, the classic definition, 2 negative GDP quarters back to back. Now, with such a strong labor market, it's difficult to say recession. There are a lot of great economists who are my friends, and they're on the fence. Some of them, I have a handful of economist friends, and I have quite a few PhD economist friends here in New York, in my area here. They're actually part of my chess community. And 2 of them say, we're not in a recession because the labor market's too strong. And one of them says, we are in a recession because of the 2 negative GDPs back to back. So it's like there's different perspectives. And that's what I love about speaking with other people in the field, because you learn, because you see all these different perspectives. The same thing with the housing market. Could it just be a cooling down? Maybe, a much needed cooling down. How much will it cool down? Will it cool to the point where it crashes? We don't know yet, but right now it's very concerning. I absolutely agree with you. Demand is down. The buyers are being priced out. Inventory is still so low. I mean, we have historically low inventory levels in our area. Usually for prices to come down, you usually have higher inventory. So you have that issue as well. And I got to tell you, my area here in New York, in this New York metro area, our prices are still going up. And I just saw that, homes are staying on the market a little longer, but the inventory is so low. And our home price has stabilized or has just gone up a little bit. But I think maybe this month it's stabilized, but it's not really coming down. So maybe we have a different effect here. We have like the New York metro area effect from post-COVID. Who knows? But I was reading some research yesterday that says that the national estimates are that we're going to have a 5% decline nationally, with some markets still increasing. So maybe our area is one of those increasing markets. Yeah. I don't know.
New York is always going to be hot.
I know, right? New York is always hot. But so we'll see. For foreclosures are actually below normal levels right now, and so that's another thing. That's a positive. And then we have owners' equities are much higher than recent past. So that's still going on right now. And I read that, I think Realtor.com, I think that's where I read it, or was it Forbes? I don't know, one of the sources. So, and mortgage products, we all know that are less risky with more regulations and restrictions than in the past. So we have those positives going for us. So hopefully we won't have much of a crash, but we'll have to wait and see. But with recession and stagflation possibility, we could have much greater issues. So that's the thing, like nothing exists in a bubble. So the labor market, we know, affects inflation and affects housing. So if the labor market actually turns the other way and we start getting unemployment going up significantly, then that can come over to the housing market and cause people to default on their payments because they're out of work, they're not able to work, and then they have that issue. Even if they have low rates on their home, if they can't pay their mortgage, they can't pay their mortgage. So, there's all those other issues. And, we discussed rising debt, declining savings, so we hope for the best, but we prepare for the worst. So I think that's the expression. So that's basically it. So thanks so much for sharing that point of view regarding the housing market, because we should all just remain aware of what could potentially occur. Not to be fearful, because that's not what we need to be, just to be aware. Awareness is key with everything. So, let's segue to another appropriate topic, risk management. I know we talked a little bit about it before, and you use some type of risk management, but what is your risk management paradigm involve?
In terms of what, trading or investing?
Both.
Okay. So in terms of trading, I'll mitigate the amount of money I'll use within my trading account. So I mentioned a little bit earlier, if I don't like to let my trading account get more than 25K. That's the budget I'll allocate myself. I'm not going to use the full 25K either. I'll use between 5 to 15% per trade. Within that said trade, I'll look for the most optimal entry within my mindset, within my trading skills to get in there, and I'll use stop losses when I enter my position. And I'm going to go into every single position with a set mind, a previously set mental level where I'd like for my stop to be, which is within using support and resistance levels of, depending on if I'm taking a put or a call, I'll go in with a certain level for stop loss. And as the position hopefully moves within my favor, I'll adjust my stop loss and begin scaling out. I'm not looking to get in at the bottom and get out at the top. That's one of the biggest mistakes traders make, is once they have money, they don't take it off the table. I will slowly scale out of my position as it goes in my favor, and I'll use my indicators and my levels to kind of adjust me and be my guides through this process. And I'll try my best not to let like emotions dictate me, right? Like if it looks like a position's going against me, I'll swallow my pride and cut the position even before the stop loss hits. Because I think one of the biggest things that plays into this factor in terms of like risk management is you got to learn like swallow your ego, swallow your pride when you're trading. And if you're wrong, and that's okay. I think the biggest issue is within the world of FinTwit and the world of finance, the greater world of finance, is everyone's so scared to be wrong. Everyone's like, oh no, if I'm wrong, I'm going to lose all credibility. Like no one's watching, no one cares. It's you versus you. It's your money on the table. Just cut it and don't try to do it. And I'll follow the trends. I'll look for where the market's going. The market will give you direction every single day. It'll tell you where it's going. Either it wants to go up, go down, or it's wanting to go sideways. And some days it'll do all three. You'll have some days where it'll do all three of them. And you got to listen to the market. Don't try to beat the market to it. Like one of the biggest things, like we had a massive conversation with my team last night and then a lot more today, and having it more prevalent now because my main thesis is education with my team, is follow the trend. Focus on the trend. Don't try to beat the trend. Like if yes, Tesla's down significantly in the past few weeks. That doesn't mean it has to go up, right? It can continue to go down. If Elon files tonight that he sold another $700 billion worth, whatever money he has left in that company, in Tesla, it's going to go down further. Your RSI, which is our favorite, which is our indicator for oversold, has a flaw in it. You don't know how long it's going to stay oversold. You don't know how long it's going to stay overbought. There's no rule where it has to bounce.
I love that. Exactly.
It's like keep these things in the back of your head. The market, you wake up, like for example, I'm a day trader. A lot of the folks in there will day trade. If we're going up, keep an eye on everything going on. Keep an eye on economic events. Keep an eye on what's going on. If we're going too high, if we got in at a good time, we scaled in, beautiful. It's going up. Let's start to scale some of that out. Like I'll do that myself. Like if I go in with 25 contracts, my first initial scale out will be 15 contracts, 20 contracts. Then I'll leave 5 for my quote unquote runners to juice that position. And if it goes good, perfect. And simultaneously, I'll be moving up that stop loss across the way because I don't like to leave money on the table. Like this is again one of the negative sides of FinTwit is don't use a stop loss. Just go use money that you're willing to lose. Well, I don't know about you guys. I don't want to lose any money.
No.
I know I'm going to lose money. It's a stock market. We're going to lose money inevitably. So I'm going to try to mitigate that, right? It's called, like, for example, they call them hedge funds because they hedge, and one of their biggest mottos is capital preservation. So I'm going to try to preserve as much of my capital as possible. I know I'm risking capital, but I'm also going to try to preserve it if it goes wrong, because who the hell is right 100% of the time? It's just not going to happen. So I'll use that. I'll use these tools that these brokerages, thank God, have given us in terms of a stop loss, and I'll let that be there. Let that guide me. And sometimes it'll stop my runner out on its way up. Like today, I was in a set of call options, and I got out before it let me. Before I did anything, I got out. And then there was another set of call options towards the end of the day where I had a stop loss set. I stopped paying attention. I zoned out. To be fully transparent, I was extremely tired. I zoned out, and the stop loss broke me out of break even towards the final contract because I just wasn't paying attention, and it helped me there. Like the trade could have gone south, it could have gone to zero. Yes, I would have lost money. Yes, the trade partition of the trade was scaled out at a profit. But again, they're there to kind of protect you. So I think like don't listen to FinTwit because a lot we're seeing, especially now, a lot of the things that are being done are fishy, and it's you versus you. You don't trade to impress anyone. Like no one cares. Like it doesn't matter whether you make $50 or $500,000. Just you look to practice and get better and better with what you're doing. And don't trade to impress people. Like, no one wants to see your profit and loss margin on Twitter. Don't trade with that in mind. That's the thing. People, this is the thing that always baffles me. You'll never see me post that we will screenshot screen that has the percentage, because what's happening there is people will go there, and I used to make that mistake too. People will go hit that button. Oh, let me take a quick screenshot. Boom, and then you start to see the position start to reverse. I just lost money because I wanted to take a screenshot to impress a bunch of people that I might never see in real life. It's like, what are we doing here? So it's like,
I like that.
It's like it's trying to like mitigate these things both within a technical standpoint with things like stop loss and mentally, because psychology plays such a big factor in trading that it's one of the biggest battles that we will all fight. I think like a lot of trading is psychological.
Absolutely. 70 to 80% is mental. So absolutely, you can have all the skills, you could study all the books you want, read all the books, practice, but if you don't execute properly, you're not going to make money. If you can't control your emotions during volatility, and you're not going to make money, you're not going to be successful. So it's about execution. And I know we've used that word quite a bit through our discussions. But yes, not getting influenced by other people, not getting swayed, ignore the noise, try not to be so showy. I agree. Like, sometimes when you do that, and by the time you take your picture and you show it to everyone, you're lost. You're going to turn into a loss or something. Right. It's funny you say that, because I've heard of that happening. I don't get involved with posting any of that stuff. It's so great to see how mature you are about that as well. And that's the makings of a great trader and a great educator. You sound like you run a great team over there.
Thank you. That's my passion is just my thing. This is a mantra that I live by. Is like, I don't want to be the best trader in the stock market. I'm going to work my best to become the best that I can be, but I want to be able to create a series of fantastic traders to leave a legacy behind. That's like that's my passion here. Is like the only reason I'm here on Twitter is because I want to help people learn how to trade and execute trades and become traders or become investors. Maybe trading isn't for you.
Exactly.
Become an investor, right? My main thing is like, the stock market has been kind to me, thankfully. It's been a tool that's been able to help me do things that I never thought I could do. Like, I'm sitting in an apartment where had I never crossed the path of what I'm doing right now, I would have never been able to afford. Like, it's not a lavish apartment. I'm not sitting in a penthouse in New York City. It's nothing like that. But it's just the trajectory of life that I was on. I would have never been able to afford to move out for a longer period of time. I would have been in a much, much different standpoint in where I am in life. So I want to be able to pass that on to people. Like, the most satisfying thing for me in life recently has been, more than anything, has been someone reaching out to me and being like, hey, like, this video that you posted helped me do X, Y, and Z. Or this helped me do this. Like, one of the most impactful things that happened to me last CPI was someone commented and said, to the variation of, I have it posted on my Twitter because like it moved me to the point of tears, where he was like, hey, look, thank you so much for the CPI video. It helped me execute my trade and let me know what I'm doing, to the point where my mom doesn't have to worry about rent. And like, what am I supposed to do with that, right? Like, there's no profit or loss that I can make that'll make me feel fulfilled as the way that does, right? And it's just, to me, like, that's my passion here. Is like, I just want to like make better trades. Like, I don't care. Like, I'm not here to gather followers. I'm not here to sell you anything. I don't care about any of that stuff. It's just my like mission has been like, how can I leave a legacy behind of traders who can then pass that on to their kids? The same way that my father always told me. He said, hey, look, like, son, like, I came to this country, no one told me about anything financial literacy. Like, one of the biggest mistakes he made was he got a classic IRA versus a Roth IRA. And he always talks about it. He goes, no one was here to teach me these things, so I'm going to teach them to you. And now I don't have any kids yet, right, or anyone to pass this on to. So I'm trying to pass it on to the world of Twitter and Entrenchment, so that maybe 1% of the people that are impacted by this can then pass it on and ricochet, and we can have like an exponential effect by this. Because it's like, we're in the stock market. It's not you versus me out there. It's we can all benefit from it, and there's tools for us to all do great. So it's like, I think anyone can do a variation of the stock market. Whether for some people trading, they just can't do trading, and that's completely fine. I believe that anyone can do it if they put their mind to it, but some folks won't be able to have the time to be able to dedicate to it and become traders, and that's completely fine too. On that side, you have investing. And if you can't do investing in individual stocks where you do fundamental analysis and read into these reports, you have baskets of stocks via ETFs, and you can invest in ETFs. And if you can't do that yourself, then you can go to like a money manager. It's just about putting your foot into the stock market, because it's such a powerful tool. Like every single millionaire, billionaire, whether they're a comedian or Warren Buffett, has money in the market for a reason. It's such a powerful tool. And that's kind of like the biggest thing is like, I want to be able to pass that on to people in this community, because like you'll see my account, right? My account, I've been here since 2020 of March. Relative to everyone else that I came up with and grew up with, my account is probably the smallest. And that's not, I'm not trying to make a point or a comparison. The point is because education isn't sexy. The thing that I'm pumping out and trying to share isn't sexy. I'm not posting alerts. I'm not doing this. I'm not doing that. I'm trying to like educate at the macroeconomic scale. I'm trying to keep people aware of what's going on. And that's not the hottest thing, which is unfortunate. So that's why I will push as much as I can to increase my impact to the community that I have and give back to the people that want to learn this. And hopefully it'll spread like a virus, so more people will want to be able to learn and educate themselves. Because the thing that happens is people come to FinTwit with the goal of making money. They realize that making money is much harder than they think it is. Like copying someone's trades maybe will work for 1 to 2, 3 times. On the 4th, 5th, and 6th, you'll lose all that money you made plus more. And then hopefully on the 7th trade you go to take, you don't take that trade, and you realize, okay, maybe I want to learn this. And I think that's the inflection point that I'm trying to catch with people, is on that 7th metaphorical trade, when they look for someone to help them, I can help them be that guide, whether it's via a YouTube video or whatever it could be, to kind of help guide them. Like that's the main reason that I'm here. Like I sacrifice a lot of my personal time in my life to do this, and I'll be honest with you, it's very struggling and very hard to do this, and sometimes I don't like it because of the mental fortitude. But like one of the biggest things that I'm like studying up on is like in life, you have to, if you want to make an impact, there has to be a bit of suffering. And I think like this is the quote unquote suffering, is I sacrifice time in order to make a larger impact, to be able to make my impact in life on this micro scale. And that's kind of like that's kind of my main thesis. But the unfortunate thing is, like, when your account gets this big, it's not relative, like it's big, right? You get lumped in with a bunch of people who are nefarious and do wild things. So they average you out. So, which kind of sucks. But I mean, I'm still going to keep doing what I do. I love it. Sometimes I'll get tired, and you'll see me react that I'm exhausted, and why aren't people paying attention to this? Like, this is important, pay attention. But I mean, I'm still going to keep trying and going, because it's like, I know the grander purpose of all this.
I love it. Everyone, make sure you follow Ryan. That was so passionate and brilliant. You are so real. You rival me. I have to say, people say I'm always too passionate. I get very excited because I think we share similar values. And I'm so grateful to our friend Ryan, Captain himself, who brought us together. I mean, we knew each other, but he's like, yeah, you got to meet up with Ryan for space. And absolutely so grateful, because we share the similar values. You know, I'm a first generation here in this country. It sounds like you are as well.
Yep. Yeah, my parents immigrated here about 30 years ago.
Wow. May I ask from where?
Yeah, my parents are from Iran.
Very nice. Wow. Amazing. Well, my parents are from Italy. And so, yeah, so I was the first to be born in this country. I actually am the first to be in higher education. My parents were, they were from Italy, from the mountains of Italy and the beaches near the Amalfi Coast, actually. And they weren't really educated, so they didn't have the opportunity. And so they came to this country. And so I'm first to be educated, and I've more than fulfilled any of their dreams for me. I'm very grateful to them for all the opportunities I have available to me. So like you, we share that same upbringing, that same, just that work ethic. You know, we reap what we sow, and you have to make sacrifices to get what we want out of life and what we need. And you know what? It's about giving back. I'm so grateful. You know, I worked very hard in my life. I've had, we're all self-made, and we're very honorable people. And everything we do is always with everyone in mind. It has to be a win-win. And that's how I do business.
Right.
And when I coach people with CEO, I've consulted other CEOs. I've been a consultant for years as well. I always look for solutions. I'm a problem solver. Being a serial entrepreneur, I've started and run, I've sold many businesses, been very successful. I'm very thankful.
That's awesome.
And it's not a zero-sum game. And that's very important. You brought up that point. You were so wise at such a young age. The trading is not a zero-sum game, and either success. It's not my win is your loss, and your win is my loss. And no, we can all succeed together. And actually, success breeds more success. So,
Exactly.
absolutely. So, like-minded people, positive growth mindset people like you and I, and like many other wonderful people that I have met on Twitter, I'm so grateful. And the purpose why I'm on Twitter, I came on here. I started at Stock Twits, and I love talking stocks, and I was sharing my knowledge, and I came here to enlighten people, to help people with fundamental analysis, to share my investing insights. You know, for many years, people call me an expert, and I have to admit,
awesome.
Malcolm Gladwell says 10,000 hours, you're an expert. But for some people, it takes much less. Our children, we're so grateful. They're all chess experts and masters. They were professional chess players playing at the Marshall Chess Club at 5 years old. My youngest became a candidate master, won bronze at Pan American chess championships at 6 or 7 years old. 6 years old. So they've traveled the world in chess. We took years off from work, and we had our businesses that ran passive income. So we were able to travel and with their chess accomplishments. But basically, what I'm trying to get at here is that, like you said, hard work precedes success. We need to make these sacrifices to reap rewards. And it's always about a win-win for all. And we're here to share and help others. And we raised our kids that way. Our kids are actually teaching chess to other kids. They've started programs many years ago. They're early teens, they're 13, 15, 16 now. But they actually teach other kids for free. They run chess tournaments, and they do this all voluntarily. They're actually starting a global chess program where they're teaching disadvantaged kids in Ecuador chess. So they're doing it through Zoom. So, and not only were they teaching kids locally, but they're doing that because we teach them that we're here on this planet, on this world, to help one another and to share, to leave a legacy. So for them, being chess masters and experts at such a young age, they're able to help others. And chess brings so much to other children who are disadvantaged. So, and they're helping others in the community. So it's really great. But yeah, so I've spent over 20 years being an entrepreneur. People have called me an expert in business and investing. I've done real estate since I was a child. My dad actually was a real estate investor. He was a self-made entrepreneur as well. He came to this country, didn't speak the language, but he learned, and he had his own business, and he became a real estate investor. So I learned by watching him, and then I became real estate investor as well. And I was a commercial real estate broker, have my own brokerage as well. I've lived many lives. A few people have said I should write books about it. I had a women's only health club in South Florida when 9/11 happened, and the anthrax scare was actually right in my area. I could go on and on. I don't want to bore anyone. But the bottom line is, people call me expert in investing and all that. But being an expert means that you learn every day, and you're always learning. And it's about, you make expertise-based intuitive decisions because you have that pattern matching. There's these recognizable prototypes in your head that you're always basing situations on because you've gained that tacit knowledge. And that's through experience. Like we said earlier, it's experience versus theory. So you gain that experience over time. Seems that you've had significant experience. And I have to say, make sure you follow Ryan, because you are not only so smart and a great trader, but you're a great person. And that's the most important thing of all, is that you genuinely care to help people. And that's so meaningful. And that the world needs more people like that. I hope everyone, if we all help one another, we're all going to elevate together. So I think it's really, really great stuff. So back to risk management. I'm just gonna, my 2 cents, reduced position sizing is great. I like to sell calls and sell puts. I'm an options writer. I prefer being in that position. So whenever I initiate trades, or let's say I want to initiate a position, an investment, I like to sell puts. I don't know if you do that strategy, but I could go out of the money and I sell puts out of the money. And so I choose a strike based upon a price that I don't mind owning a company at. And I've tweeted about this. I'm like, if I'm going to buy 100 shares today, why not sell puts on it at a lower price? So I do that strategy quite a bit. And I have been doing that this year, and I've gotten some shares at an agreeable price, and others I've had expire worthless. And that's a great income strategy. So I use options for risk management and income strategies as well. And I love that point that you made. So wise. There, if a stock goes down like Tesla, doesn't mean you need to buy it because you think it's going to go up. Just because it's down so much doesn't mean it's going to go up. And the same thing I've heard a lot of people say on Fintuit community, oh, this one's run up so much, means it's time to buy puts. It's got to go down. And I saw someone, I think, say that about SMCI. And they're like, oh, this stock has run so far, I'm going to open up puts on it. And it's like, have you really looked at the fundamentals? Have you really looked a little deeper to really make that claim to buy puts because it ran up so much? I think that, is a little of a novice thinking. So if we don't want to lose money, we want capital preservation is key. Let's drop all these axioms, which are buy the dip. That's one that should be gone this year, okay, right? And then the other one, let your winners run. We had a risk management space like a week and a half ago, 2 weeks ago, and that was another one that came up. Actually, in this market, you have some profits, maybe you should consider taking them, because I got to tell you, whenever I try to let a winner run in this market, that green goes to that seems to go to red more green. So that's another
things don't
axiom.
stay consistent for too long these days.
Exactly. Nothing seems to stay too consistent. So the other one is just because something goes down doesn't mean it's going to go up. And just because it goes up doesn't always mean it's going to come back down. So yeah, we got to tread carefully for sure. So you have a great mindset, and I have to credit that to, you must have great parents. You had a great upbringing. You just a great person all around. And I just love your attitude. You're welcome. How humble you are. And that's key. We could be experts in certain fields and always stay humble. And you seem definitely to be an expert in this trading and this mentoring as an educator. The guidance you provide your people sounds wonderful. Before I get into you telling us about your services, because I know we're all interested to know what you offer, what do you think for 2023? Because that's the big question I'm going to be asking everyone. What sectors or asset classes are you looking at for 2023?
That's a very, very difficult question, and I've been thinking about that question for a long time. I think the energy sector is one that I'm looking at very closely to position myself into. It's one that I'm learning more about, hence why I haven't pulled the trigger on it yet. Energy is definitely one of them. And it's not just because it ran in 2022. It's been the one hot sector that did so great compared to everything else that really went to hell, right? It's because I'm truly understanding the impact of the energy sector. And they might be saying, this guy's an idiot. Why didn't he know that before? Well, that's the process of learning, right? We don't know anything until we learn it. So I've been learning more about the energy sector and the components of it and how it operates. So that's one that I'm personally looking at. And I think it'll continue to have an impact because you'll see places like China reopening. You'll see other places that are going to reopen more. You'll see COVID start to die down, and China's huge, right? So it'll have an impact there. And also, I don't think that, unfortunately, I don't think the Russia-Ukraine situation is going to die down. Everything that's going on right now. So it'll still be a sector that I'm watching, but I think that the it's very hard to blanket for 2023 one sector. I think you have to look for individual companies that have their merits, look at their earnings reports, find the ones that you use. Like that's one big thing that I like to do is I look for a company that I use. Like for example, I mentioned TSM earlier. Again, not financial advice, just discussing it as the example, just referring back to it. I'm like, I got an iPhone. I have a graphics card in my computer. Everybody's talking about chip shortage. AMD, everyone automatically goes to like AMD and NVIDIA, but those guys are really chip designers. They're not chip manufacturers. But you have TSM that's manufacturing chips for companies like NVIDIA, AMD, Apple, a lot of much smaller companies that add up to a big share of it. They have good stuff. So, the tech sector is completely beat up. And yes, there's the bear market aspect of it, of, China can invade tomorrow. But I look at this, I have to look at like individual stocks and I'll go there. Or for example, like in the mineral sector, a new company that I'm looking at in the mineral mining sector is SQM, lithium mining, right? All these EV cars are popping up. Everyone and their mother is going into EV cars. Honda, Toyota, Tesla's in there going bigger and better. So I'm like, all right, I need to look for the parts, right? So I call these shovel and pick plays, where it's like, I see the greater aspect of it being the EV markets. What are the parts that add up to the sum of the whole? What is this shovel and pick play? You've got things like EV charging and you have minerals, right? EV charging, I haven't been able to find a company that I'm too crazy about at the moment to get into. But I know, like, for example, minerals, I'm looking at SQM, I'm looking at Valley. So these are the two companies, again, not financial advice, I'm just sharing, being transparent here. Two companies that I'm looking at extensively. I have a position in both of them, but I'm looking to expand the position. I think it's really the year for individual stocks. And if that's a challenge, I would suggest looking for basket ETFs, like the S&P 500 parallel or the NASDAQ or the Dow, and going into those. I don't think it's a good idea to sit out of the market. I think the best thing to do is dollar cost average, even if we have another negative year. Let's just say it's another negative year, and you dollar cost average on the way down, and it sucks. Even if it's like my dad, who was putting $50 into the market every month for many years, markets will swing back up when they do eventually, whether it's like some people say it's going to be the lost decade. For 10 years, it's going to be hell, and then we come back around. Or it'll be 2 years, or it'll be 1 year. We don't know that. That's why timing the market's so hard. So, like, if you can't do the individual stock thing, look for the broader basket. Pick which one you like. Look for one that has a low expense ratio, that's balanced out risk. There's tons of them out there. For example, like in my Roth IRA, I put VTI. It's a parallel to the S&P 500. Very similar holdings, almost parallel. That's what I do. And find what works for you. I don't. A lot of people I'm seeing talk about like it's going to be another hell year. And yeah, I'm sure it will be another hell year. And it could be another hell 5, 6, 7 years. But I don't think sitting out of the market is the right decision. So long story short, I would look for individual stocks in sectors that could have massive potential or any potential in the long term. Look for them to be positive cash flow. Look for them to have cash in their balance sheet so they can actually afford to get through a recession if we have a longer term recession. And if you can't do that, that's completely fine. Look for baskets or ETFs that fit your criteria of what you like, whether it's massive broad market, global markets, individual sectors that you like. Just, I think the most important thing would be to stick to investing, stay investing, because long term it will pay off if you buy good stuff. I know that's a very cliche thing to say, buy good stuff, but like invest in companies that have their bearings, or invest in these baskets and let the people who run these baskets do the hard work for you.
Love it. Exactly. I think it's been a select stock market for most of this year. I've been very fortunate to have picked, quite a few, but I guess, I had many losses over the years. It's about time, right? I've done my work and I reap my rewards, right? I've just, having done major financial analysis for so many years, for me, like you said, find the good ones. And that's exactly it. I look for fundamentals. That's key when I buy a company, especially with tightening liquidity and compressed margins. So I'm going to keep mentioning SMCI. The reason why I mention that company, it is not a buy recommendation, everyone. Very important you know that. I'm not saying to buy it at all. None of this is financial advice. I'm using it as a teaching example, because here we are as educators. We're here to share our knowledge, to share our experience with others. SMCI is an example of a very beautiful financial company. If you look at their recent earnings reports, they've had a pattern. where they raise their earnings before the earnings come out. Earnings expectations are raised. They come out with their earnings, they beat, and then significantly, and then they raise their guidance again. This has been a pattern 2 times now. And during this time period where we're going through all this tightening, all these rising rates, all these compressed margins, and so forth, and we see earnings per share up year over year, triple digits, and phase as well as another one that's had significant rise in earnings per share. So it is a select stock market. There are quite a few emerging leaders, I call them, that have beautiful financials right now. So to generalize and say the whole market's bad is wrong. Absolutely. So I agree with you. It's a select stock market, and in my opinion, it's going to continue into next year. Select stock market. Now, could these same emerging leaders continue? Maybe, most likely, hopefully. Could there be new ones? Absolutely. Anything's possible. But I always keep an eye on all the earnings reports. And being a very, heavily math person that I am, I love running the numbers. I run my own calculations on them as well. But free cash flow is tops for me. And it's always about cash. Look, rising cost of debt and capital, reduce productivity, rise in production and labor costs. Well, to me, margins maintained or increasing, that's a star. That's key. They get points for that. And then to see cash flow, free cash flow, that's impressive. And increasing in earnings per share, those are tops for me when I select my stocks. I think it's going to be challenging for the 60-40 portfolio. Commodities are definitely showing their strength so far. If we do get stagflationary conditions into next year, then I'm going to be probably looking at remaining with gold and silver. Now, I do have positions in gold and silver futures, and I will hold those positions. They've been doing great. I mean, fantastic. You have the ETFs as well, the silver, silver, I can't even think, SLV, that's it, whatever it is. But that one, and then gold, GLD. So you have those ETFs. They aren't the physical assets. So, but that's why I prefer using the futures. And that's had a significant run. I'm definitely holding cash for me because I like to remain liquid to seize opportunities, as there will be many. So don't know when that time is. Many people thought we would have turned around by now. But when you look at the macro conditions, it makes sense that we aren't, and we're still in this, and we may be in this range. It's more like a range bound. It's like a downward range bound. We may be stuck in this range for quite some time. So there are a lot of other vehicles for, like commercial paper, T-bills and stuff like that. And I tweeted about that earlier today, to, use your cash for short term. And so there's a lot of potentials, opportunities out there. You just got to find them. It's not an easy market, like we said, like 2020. You need to do your work, and that's how investing is. You have to do your work, and things don't just come easy. Otherwise, everyone would have a lot of money, right? It would be so easy, everyone would have it. So, yeah, so it just requires work. But there's definitely opportunities, and there's definitely, like example, SMCI. And if I got a penny every time I said that stock, I don't think I have to even invest or trade anymore. But just an example of just, there are success stories, and there are people producing numbers, favorable numbers in this environment. So never give up and just remain positive, because there is light at the end of this tunnel. So, Ryan, tell us about your services.
Sure. I'll preface this. It's the equivalent of a not negative profit service. So I started this a while back. I treat it as a reverse Kickstarter. So the core of what Trading Together is it's a team of traders with the hopes of educating and creating traders that are either new or want to get better or even get better, right? Like I've learned significantly from the team there. We all learn together. We all trade together. We all discuss. It's not an alert-based farm system. that you might be used to. It's not somewhere to come to get signals to copy trades. So what the point was there's a cost to it, right? And the reason there's a cost to it is it's used to fund this bot that we're building. I'm building this bot. I hired 2 devs. I work on it periodically myself as well. The 2 devs are my friends, and I pay them literally everything that comes out of into the Patreon piggy bank goes to them, goes to the APIs, goes to running the services, with the goal of building this really cool trading bot. And I put this trading bot live to the team, and it's thank God so far it's been really good. It's done well. I post the results of it daily on my page. The reason for posting the results is A, there's a marketing angle to it, but B, it's really more of like, hey, look, like I'm actually doing something really cool and I want to share it with you guys. So that's what the service is. You get access to. I create I mentioned a little earlier in the night is like every night I run an exercise where I chart stocks, the stocks that I like that I'm looking to go into it for tomorrow if SPY doesn't work out. I create a watch list there. I put all the levels both to the upside and downside on said watch list, and I share that. I also feed that watch list to the bot where it uses it to process along with the different APIs that it has to pull data from the live stock market. And then that bot will alert based off of code that we've built into it, based off of the APIs that we fed into it, a signal of where it thinks a viable option trade could be. And that's for entry. And there's a how-to video, and if you would like to join, we'd love to have you in there. But the core, most important part of the team is it's meant for folks who are looking to become traders, learn how to trade, become better investors, learn to do this, because I've also created 4 sets of courses in there that will be available to you that are living courses that periodically I'll add videos to when I get the chance to, where you can learn trading stocks from soup to nuts. And then there's live lectures that I'll do periodically, aimed for every month, once to twice, where it's a live lecture about an hour to 2 hours on Zoom, where I'll go over a certain topic that's there. Like I'm aiming for this weekend to cover trends. I know it's the holiday weekend, but I'll probably just do it myself and record it and post it. And then we'll do Q&A at a different time so that I can interact with them. And the most important thing about this is it's not like any other Discord you've probably seen. I've had the pleasure and unfortunate misfortune of being in certain Discords while I was trying to learn and understand how to make one and how to do this, to be able to create a community, which I wish I had when I was coming up. And the point of it is I'm here at your service almost 24/7. I've got people that message me at 2 in the morning. I've got people that message me at 7 in the morning, during the day, anytime, where if you have a question, I'll do my best to help you out, with the goal of you're coming into this world, into this space, into our little universe, to learn trading, to become a better trader, and your contribution isn't coming into my pocket. Like personally, full transparency, last month, $1,300 of my own money was added to the Patreon piggy bank to fund the bot, right? Because we were making further developments. I needed to pay my team, and I want to make sure that they're handsomely compensated for what's being done. So I wanted to make sure that they're done. And of course, costs are going up for a lot of these things that we've subscribed to. So we had to do that. So I paid. So it's not like other services where you see the head guy is making millions of dollars or money from it. It's not. I don't make any money from it. I just lose a lot of sleep over it, and I'm losing money on it too. So it's just like you're being a part of this bigger thing with a goal of becoming a better trader. And I'm going to do my best to provide you with as much value as I can. And the best way that I found is the difference between our server versus any other server is I'm there 24/7 helping as best as I can. I've got other admins, like for example, Jay is in the chat. Jay is one of our admins there. He helps out significantly in helping folks become better traders. So it's like we're just trying our best to kind of help people. It's a small community on purpose to be able to help people become better traders. And I'm more than happy for anyone to join. And if you have any questions before you join, you can always message me. My DMs on Twitter are always open. You can message me. I can help you answer any questions to see if it's a fit, because for some people, it's not a fit. They're looking for alerts. And yes, we have alerts via another one of our admins, the bot. But the main goal of this is for you to learn to become a better trader. So for example, in the morning, I'll put out my plan of how I'm planning on trading SPY. And then like a sports commentator, I'm in the stock chat talking exactly what I'm seeing and where I think it's going, what it's going to do, and the move that I'm going to make. So it's really like the best way I could put it is if you were watching the World Cup, you'd hear them go like, Messi goes left, Messi goes right, Messi's going for the goal, he needs to pass this. It's kind of like that, but with stocks. Like with me, it's like, okay, if we break the 90 EMA to the upside, I'm looking to take calls. If we break this key support level of 380 downward, I'm looking to take puts. Here's the chart that I'm looking at. Jay posts his charts significantly. I've tried to post my charts even more now. I've learned from Jay that the team likes seeing more charts than verbal text. So that's why I'm trying to do more now as well. So like, for example, earlier today, I posted the chart actually on my Twitter. If you guys want to go look at it, the trend line on SPY, that was the trend line we were using for calls. And then once that trend line broke, you can go and look at SPY. We took puts on the way down, and then you adjust based off of things that are underneath it, like your EMAs. So it's kind of like a community of people that are really working together. There's no egos. There's no one trying to show off. There's none of that. It's just a group of people that I've had the pleasure of working with and learning from more than anything, learning from and working with them. And that's kind of the legacy I'm trying to leave behind. I do it to a small extent for free on YouTube, and then I got this service where essentially it's free as well, because you can write it off against your taxes. This is the other thing as well, as any form of education tool that you use, you can write off on your taxes. So this stuff that you're buying is a tax write-off as well. So instead of giving it to the government, you're funding a really cool bot. So these are the long story short. If I could sum it up to one thing, trading together is a community of traders looking to become better traders via the tool there. And I, as the head, quote unquote, leader of this team, will do whatever I can to help you become a better trader in any way possible. And I'm at your service.
Love this. You're so passionate. That's so wonderful. I think that's great. I think I might have missed the part about the bot. Did you program the bot yourself?
Yeah, so I handled a lot of the programming myself early on, and then it got a little bit really too complicated. So that's when I brought on my developers on board, which are two of my buddies from college who weren't able to find jobs at the time. So they came on board to this, and that's why all the money goes there, is because I'm doing this. And I haven't told them that I'm putting in my own money for this as well, because I didn't want them to feel weird. But they came on board and they're helping me do this, because like I was finding myself being pulled extremely thin on this, doing this all by myself. It was just too much. I'll be fully transparent with you. It's too much. Running a trading team is extremely difficult, right? You'll see a lot of these teams that are run, and they'll charge exorbitant amounts of money, which I think is unfair to anyone, especially anyone who's looking to learn. And they just won't be available to the team. My main goal throughout the day is I'm willing to lose a trade. I'm willing to take an L on a trade. If you have a question, I'm going to try to help you out as best as I can to get you through. That's like the most important thing. So when it came to building the bot and stuff, I find myself exhausted at the end of the day. I wouldn't be able to contribute to it. So I had to really go out and get help. And thankfully we had this piggy bank, and we used it to get this bot going. So it's kind of like, it's this brain that we're building. So it's essentially, the thesis of it is, I used to have a watch list. We used to create the watch list. By we, I would be me. I'd create a watch list every single night. I'd post it. And then throughout the day, I would share what trades I'm taking off of it. This is months, over a year ago now, since the bot's initial inception. And then I'd find myself like, I'd come at the end of the day, run results in the watch list and be like, that trade would have performed much better than this trade that I said. And that trade performed horribly compared to this trade that we could have said. So I said, what's a way that I can share all of these becoming viable to a certain extent? And sometimes it gets it wrong. How can I share all these becoming viable without me having to monitor 4 to 7 different stocks every single day, all day? Because it's going to drive me crazy. And I had this passion for building the SPY bot parallel to it. That was the initial move, which I found was brutally hard. So I retracted back, came back to building this watch list alert bot. So we built this. We built the brain, the initial inception. It was, of course, it had its bugs in the beginning. We tweaked it, and there's massive updates that we're working on now of building it to kind of build in more risk controls and risk tolerances into it. And we're constantly like looking for better APIs to bring in that get us data faster, that get us more information that we can pull in. We try to program it better. These guys are doing it at a fantastic level. So I'll be honest with you, it's just like I needed help, so I had to bring on more people to help me build this bot.
Love it. You are so dedicated, passionate, so wonderful. Thank you so much for everything. You know, my husband, is he here? Yeah, being frank, he's in the audience here. He's a listener, and he's so grateful for you as well. And he's also, you're welcome. He's also first generation here. His parents were from Italy, just like mine. He's the first to be educated in his family, and he's a lawyer. He's a licensed attorney, but he's inactive, but he's going to be activating his license now next month. Yeah, he retired because he's an entrepreneur. It's not that he's old. He's not that old. Well, compared to you, he's old. And compared to you, everyone's old. But You're so wise at such a young age, but he's young, but he just retired from that because he's an entrepreneur and he's a vision. He's a creator. So he just creates businesses and awesome. Equipment. Thank you. So now he's reacting actually because similar mindset as you and I, he's here on this planet. He believes to help others. And, you know, he wants to help others legally as well. So he's going to be pursuing a few new projects that he's working on. But he sent me this quote and from Ralph Waldo Emerson. And he actually put that in the thread. He said, Ryan sounds like Emerson reincarnated. So I'm going to read this quote to you and everyone. The purpose of life is not to be happy. It is to be useful, to be honorable, to be compassionate, to have it make some difference that you have lived and lived well. So that he said, yeah, it's powerful, right? And he said that you remind him, you're actually Emerson reincarnated.
That's a huge honor.
Yes, absolutely. Well, you are. We're so grateful to have spent this time together tonight, Ryan. You are amazing, and you're a great person, and a great, very intelligent, and wonderful trader. And I think that you run a fantastic service. Your focus is to help others, which is the true purpose why we are here. So I am honored to have been with you here tonight.
Thank you.
And I'm honored to call you a friend as well.
Likewise, thank you.
Thank you. And thank you to all the listeners who were able to join us this evening. Of course, this space is being recorded and it will be converted to a podcast on my the Row Show podcast. You know, I have a podcast as well. So
that's awesome.
Yeah, so this is actually going to be on all the outlets. My podcast is on Apple, Google, you know, you name it, all of them. So it will be out there for others to know more about you, Ryan, because you truly are an amazing person. And that's the reason why I do these spaces, really the podcast, is just to share knowledge. Obviously, I don't get paid for this. You know, this isn't, you know, I do this because just like you do it on your own time, because we're here to speak about great ideas, experiences, and knowledge in the hopes that we can help one another. So thank you so much for spending time this evening with us. And is there anything that I forgot or left out that you would like to say, Ryan?
No, I just want to say thank you so much to you and the audience for listening throughout this whole time. And thank you so much for having me. I mean, this is a fantastic platform that you've created and allowed me to speak on, which means a lot. Like, it's the first time I've done one of these in the FinTwit space. And it's really nice to be able to tell your story and share with people the truth, because like there's a lot of negative narratives that go around, because like when I first started this quote unquote service, everyone thought it was like a money grab, and then like it's really nice to be able to share the narrative behind it with a group of people that are willing to listen. And it's really nice to know that there's other folks like you that are in this community that are looking to kind of like better the community through education and tools. It's like teach someone how to fish rather than giving them the fish.
Exactly. I love it.
Thank you so much for having me.
Absolutely. Thank you so much for being on this show. And we look forward to meeting again. Absolutely. And thank you so much to all the listeners. And have a great evening, everyone. And until next time, take care.
Thank you for listening to the Row Show podcast. Please visit RosannaPrestia.com for more episodes. See you soon.